Stocks sell at silly prices from time to time. It doesn't take a high IQ to figure out that they're cheap, but it does take a temperament that's willing to step up and actually act. That was a quote from Warren Buffett, the 92-year-old CEO of Berkshire Hathaway, one of the largest companies in the world and widely considered the world's greatest investor. Every year he writes a letter to shareholders outlining the returns of the Berkshire Hathaway stock since 1965. From that time to now, he has achieved an average return of 20.1% per year, while the S&P 500 has only returned an average of 10.5%. Berkshire Hathaway's total return over the years has been 3.6 million%, compared to the 30,000% of the S&P 500. In this video, we will be examining some of Warren Buffett's advice that is particularly relevant to the investing environment that we are entering in 2023. In 2022, the market has been declining, inflation was high, but appears to be decreasing currently, and interest rates are expected to continue to rise in 2023 due to the Federal Reserve's desire to bring inflation back down to 2%. When taking into account the potential for a recession, investors have much to consider in 2023. Before continuing, if you are finding this content useful, consider taking a moment to hit the subscribe button, like the video, and turn on your notifications to stay updated on our latest videos. When asked in an interview if he was concerned about the stock market declining, Warren Buffett replied that it is actually beneficial for him. He explained that as a long-term buyer of stocks, just like someone who buys food, he expects to continue buying stocks for the rest of his life and hopes that stock prices will decrease. When stock prices are low, it provides an opportunity to buy more shares at a cheaper price. He stated that people often have a strange reaction to stock market decline. As savers, they should want to buy stocks at a lower price, but they feel better when stock prices are going up. Buffett's logical approach is highlighted in this statement. If you are a long-term investor looking to accumulate wealth and you are under the age of 55, a decline in the stock market is actually beneficial to you. The reason being, you should still be a net buyer of stocks as you have time to invest in the market. However, if you are older, say around 70 or 80 years old, it would be more beneficial to you if the stock market stays high, since you are likely in the stage of life where you are a net seller of stocks. This is because most people's reaction to a falling market is really emotional. Many individuals tend to feel more confident investing in stocks when the market is performing well. However, in actuality, it's more advantageous to invest during times when the market is down. This aligns with the popular investing adage that states, the stock market is the only place where people run out of the store during a sale. It's similar to the mentality of Black Friday shoppers, who eagerly take advantage of discounts. Yet when the stock market experiences a dip, it causes fear and hesitancy. For those looking to invest in the long term, a falling market should be viewed as an opportunity rather than a cause for alarm. It's important for some individuals to avoid monitoring stock prices, as it can lead to emotional distress caused by fluctuations. If an individual is prone to making impulsive decisions based on short-term price changes, they may not be suited to own stocks at all. It's important to remember that just as you wouldn't sell a house at a lower price, you shouldn't sell a stock simply because its value has decreased. However, it's important to note that not everyone is emotionally or mentally equipped to handle the stress of owning stocks. However, education about what you're investing in, which is essentially a part of a business, can better prepare one for it. If you're concerned about market corrections, it's probably best to avoid investing in stocks. If you're unable to handle the fluctuations of stock prices, then it's not a suitable investment for you. The key is to identify a stock that aligns with your interests, purchase it at a price that you're comfortable with, and hold it for a long-term period, such as 20 years, without monitoring it frequently. This is similar to owning a farm or apartment complex, where you wouldn't expect to receive updates on its value on a daily or weekly basis. It's a common misconception to view stocks as something that constantly fluctuates, and it's not necessary to focus on the daily ups and downs. In summary, the best approach to investing is to focus on great businesses and remember that market corrections are a normal part of the process. Instead of feeling scared, you should view them as opportunities. When it comes to inflation, it is important to be aware that prices of materials and goods may rise, making them more costly for both consumers and businesses. During this time, it is essential to carefully consider the potential impact of inflation on investments and adjust your strategy accordingly. As Keynes stated many years ago, inflation is an invisible tax that only a select few truly understand. Investing in a strong and profitable business is an effective way to maintain purchasing power, regardless of currency fluctuations. Warren Buffett also said, "Despite the decline of the dollar by 94% since my birth, I have found that things can still work out well during inflationary periods." It may seem daunting to consider entering a world where the value of currency drops, but in my experience, it has turned out well overall, and I have no complaints. One suggestion for managing inflation is to focus on enhancing your personal earning potential. This could include building up skills and making yourself more desirable to current or future employers. By increasing your value, your income can grow in proportion to the inflation that is occurring. It is important to understand the advice that Buffett has provided when it comes to investing during times of inflation. He suggests that the best strategy for nullifying the effects of inflation is to find a high-quality business and remain invested in it. In his 1981 shareholder letter, he outlined the specific characteristics that a business should possess in order to be able to withstand inflation. Firstly, he states that businesses that can increase prices easily, even when product demand is flat and capacity is not fully utilized, without significant loss of market share or unit volume, will fare better during inflation. This means that the company has a competitive advantage or a moat that gives them pricing power. Secondly, he states that businesses that are scalable, meaning they can accommodate a much higher dollar volume of business without needing to sink a lot of money into the company to increase the capacity, will fare better during inflation. For example, a social media company is scalable because it costs next to nothing for them to show you 3 ads instead of 2. However, for a car company to increase their output by 50%, it would cost a lot in capital expenditure and take a lot of time to implement. In summary, for a business to be able to withstand inflation, it should have the ability to increase prices easily without losing market share or unit volume. And the ability to accommodate large dollar volume increases in business often produced more by inflation than by real growth with only minor additional investment of capital. Certain products have a strong brand or reputation that creates a sense of loyalty in customers, making it difficult for competitors to enter the market. This is referred to as a moat, and it allows the company to increase prices without losing market share. Examples of products with a strong moat include Snickers bars, Elmer's glue, and WD-40. On the other hand, it would be easy for a competitor to enter the market and sell a generic version of a commodity product, such as a drugstore or 7-Eleven, making it difficult for the company to raise prices without losing customers. Companies like Costco and Amazon also have a strong moat because they have created a perception in customers' minds that they offer a lot of value for their money and are therefore able to raise prices without losing market share. There are various forms of moats that companies can possess. Examples include holding a patent, charging a toll, or having a strong brand like Coca-Cola or Apple. Some companies, such as Costco, have built their moat by consistently offering the lowest prices. In any case, the key factor is whether a company possesses pricing power or the ability to control prices, as this is a key indicator of how well they will perform during inflationary times. This is evidenced by companies like Coca-Cola, who saw sales increase even as they raised prices. However, investing in 2023 also involves dealing with another major challenge: rising interest rates. This requires considering how to navigate the potential impact on investments as rates continue to increase. Interest rates are like gravity for assets. Just as gravity pulls matter down, interest rates can have a significant impact on the value of assets. If we could reduce the effect of interest rates on assets, it would be like reducing gravity by 80%. Imagine the possibilities, like jumping in the Tokyo Olympics. Interest rates can be compared to the force of gravity on the stock market. When interest rates are low, it makes it easy for consumers and businesses to access funds, leading to increased spending, profits, and growth. However, with rising interest rates, borrowing money becomes more expensive, making it difficult for businesses to pay off debt and for consumers to spend as much. This creates a challenging environment for companies to succeed in, which often reflects in their financial performance and ultimately affects their stock prices. Over the last 5 years, interest rates have had a significant impact on the stock market. In 2018, when rates rose, the market did not experience much movement. In contrast, in 2019, when rates decreased, the market saw an upward trend. The market experienced a significant boost in 2020 when the Federal Reserve lowered interest rates to zero in response to the COVID-19 pandemic. However, in 2022, with interest rates increasing, the market saw a decline of 20%. This trend is typically due to the fact that when interest rates rise, businesses tend to perform poorly, leading to a decrease in stock value. Additionally, it is important to consider the impact of interest rates on government bonds. Interest rates have a significant impact on investment decisions, particularly when it comes to U.S. Treasury bills, bonds, and stocks. Treasury bills and bonds, also known as risk-free returns, offer a loan to the U.S. Treasury in exchange for a guaranteed payout in the future with added interest. When interest rates are low, the returns on these investments may not be as attractive. However, when interest rates rise, these investments offer higher returns and become more appealing to institutional money managers looking to minimize risk for their clients. As a result, when interest rates rise, a lot of professional money flows out of the stock market and into the safety of Treasury bills, causing a decline in stock prices. In the early 1980s, when interest rates on government bonds were high, a company earning a 15% return on equity was considered average because investors could earn a similar return by purchasing bonds. However, in today's low interest rate environment, a company earning a 12% return on equity would be considered a strong investment. This is why such companies are currently valued at high prices. In the past, when interest rates were high, investing in government bonds was a safer and more attractive option than investing in stocks of companies that were earning less than the interest rate offered by the bonds. However, as interest rates decrease, the returns on stocks become more attractive in comparison to bonds. Therefore, it is important to focus on the performance of individual companies and the long-term potential of the stock market, rather than short-term fluctuations caused by changes in interest rates. As stock market investors, it's important to maintain a long-term perspective in order to capitalize on the potential buying opportunities that arise during market downturns. By focusing on the performance of high-quality businesses, we can position ourselves to reap significant returns over time. Despite the inevitable fluctuations of interest rates set by the Federal Reserve, we can take a proactive approach by identifying and investing in strong companies at discounted prices during periods of high interest rates. This is the approach advocated by Warren Buffett for navigating the three main challenges that we are facing in 2023: market corrections, inflation, and rising interest rates. If you want to stay ahead and escape poverty, check this video on the 10 habits that lead to poverty and consider subscribing